Another important issue, of course, which you can make note. There is a land and there is a building. I suppose my father acquired land in 1980. My father died in the year of 2008. That land I inherited. On that land in 2010 I constructed a house. In 2011 I am making sale of that particular land along with that particular building. Now the question before us is it a long term capital gain or a short term capital gain? Friends, please do remember, what is long term capital gain? By sale of long term capital asset, what you get is a long term capital gain. By sale of short term capital asset, what you get is a short term capital gain. What is long term capital asset? Any asset which you are holding, the period of holding is 36 months or more, then it amounts to, what is it, long term capital asset. Below 36 months, it is a short term capital asset. Of course, exception is the shares and debentures where period of holding is 12 months. That is enough for us to say it is a long term capital asset. Now the question here is, land, of course, what is the period of holding of my father will be added to the period of holding of mine. So definitely more than 36 months, land is a long term capital asset, whereas building is a short term capital asset. So in that context, when a situation arises like that, land and building, you must separately view them as two separate assets, and accordingly you have to look at the capital gains is a point. So make note of it. That is, right in holding land and the building on such land are to be considered separately for the purpose of computing the period of holding, period of holding. Then friends, another issue we have here is, I got a land in Chennai. Where? In Chennai. Where I stay? Hyderabad. हमारा लैंड कहाँ है? महाबलीपुरम रोड में. The land is there. What happened? Since we are absentee landlords, some poor people put the huts. This land I purchased, say, 15 years back. When I purchased that land, there is nobody. Today when I go and see my land, around my land big buildings came, and the property value which I purchased for 2 lakhs today is 3 crores. Now I am there with my papers, and I requested that people who are there in those huts, they said, yes sir, the property belongs to you. We are making unauthorized occupation. But since how long we are here? More than 12 years. Meantime, one educated person came from that hut. He said, sir, when I am this much height kid, I came here. I studied by staying in this hut. I am a lawyer. So, you are a lawyer. We are paying the taxes, sir, for this land. Today, we also hold some right in this, although not full right. So, अब story क्या है? Can you bring a bulldozer and can take away those huts? We gave a dhamki like that also. Then immediately they said, Sir, you have got stakes in the life. I don't have the stakes in the life. If you do something, I will kill you. Right? Now I have to come to a level where I plead them, चलो भाई बताओ कितने देना पड़ेगा आपको, so that you will make a peaceful vacation of this particular land. Then they said, give us some 50 lakhs, that is enough. Because the property worth crores of rupees, we are giving a peaceful exit, so pay us 50 lakhs. Now the whole discussion is on the point, when I pay compensation like that for the eviction of the hutman dwellers, then will it be treated as cost of improvement? Yes. Anything which you do which is going to increase the value of that particular asset is to be treated as cost of improvement as a point. Definitely, once I am going to construct a big hotel in that particular land, even those huts, although are only there in 200 square yards, still a person who comes to the Mahabalipuram to come and going to stay in my hotel don't feel like looking at those huts. Right? Only when I remove and put some big lawn or big swimming pool, it makes a sense. So definitely anything which you are paying which is going to increase the value of the asset will constitute a, what is it? Cost of improvement. This is a very important point from your examination point of view also. Once or twice it is being tested in the exam, please make note of it. That is compensation paid for, eviction of, hutman dwellers from the land would be treated as cost of improvement, because such a act of eviction will increase the value of the land, Now, another issue here to be discussed is, this is how PCC preparation differs from the final preparation. Because you should be able to correlate the things to the knowledge which you got as to the law to the practical situation. Another situation is, there is a company, it made a reduction of its share capital and made the payment to the shareholders. Will it attract the capital gain? See, this we will be studying in a deemed dividend concept 222 A to D. Of course, E is also there. There we say reduction of share capital. If there are any accumulated profits to the extent of the individual shareholders share in that particular accumulated profits, it will amount to the deemed dividend, is a point. So, in case if money or assets are received by a shareholder, when the company goes into liquidation, section 46 deals with this particular subject. Of course, we can make a detailed discussion also on that, but at this juncture just try to understand section 46 is partly a charging section, partly it is not to be regarded as a transfer section, because it stays between 45 and 47. 45 deals with what is charging, under what circumstance you get attracted to the capital gains. 47 deals with what is not to be regarded as a transfer. So 46 says what? When a company goes into liquidation and it distributes the capital assets to the shareholders, then it will not amount to transfer in the hands of the company. Whereas in the hands of the shareholder, two incomes will arise. One is capital gain and another is a deemed dividend. Generally, which companies will go into liquidation, friend? Only companies which are running in losses. But if there is a company which is getting profits, which has got accumulated profits, it is going for liquidation means what? Instead of declaring the dividends and paying the dividend distribution tax, they conveniently closing that particular company. Shankara-Vilas, New Shankara-Vilas Hotel. Right. Because once company makes the payment of the dividend, company will get attracted to the dividend distribution tax. Individual shareholder is not subjected to any tax. So keeping this in the mind, what generally people may do, we will float a company, myself, my brother, my sister, my brother, another brother, and we make good profits. Later on we liquidate that particular company, Dreams Learning Innovations, and then start a new company called as Dreams Medical EduTech. So क्या करने के लिए? Only to fool the government. So law brought a concept called as, if a company goes into liquidation and at the time of liquidation there are some accumulated profits, then individual shareholder, to the extent of his share in those accumulated profits, should treat that amount as a deemed dividend. Only the balance of the profit should be treated as a capital gains is a point. Of course, these points I will make you to write once we start discussing section 46. Now friends, having started with section 45 and well understanding the definition of a capital asset and definition of the transfer and the related issues, now I move to the another issue called as computation of capital gains. Of course, computation of the capital gains is being dealt by two sections. One is section 48 and another is your section 50. There you have calculation of capital gains in case of sale of depreciable assets. Other than depreciable assets held by the power sector undertaking, how to calculate the capital gains is being dealt by the section 48. So how to compute the capital gains, what section 48 says. Of course, I am not making you to write it because all these things are well available in the textbooks which you have. Only the points you please note, but just listen what it is. What is the sale consideration? From that, what you should reduce? From that, you should reduce the related expenses. Then you get net sale consideration. And then friends, from there you should reduce the cost of acquisition. Then from there you should reduce the cost of improvement. Then from that, any expenditure related and which is exclusively done in connection with that sale, either from the sale consideration you can reduce or otherwise below also you can make a reduction. But generally normally what we do, sale consideration less related expense, net sale consideration, from there your cost of acquisition and cost of improvement will be reduced is a point. And then friends, this indexation benefit. What is this indexation benefit? This is being dealt by your second proviso to section 48 is a point. What is this indexation? See, we are living in a economic environment where we have globalized everything. Corruption, poverty, inflation, these are not now restricted to Asian countries. That is, it's a global phenomena. See, when I came here to Hyderabad in 97, I purchased a land with 1 lakh. Today the land value is 20 lakhs. Example. I am saying that I got a loss for an argument's sake. How come? How come it is a loss? When I came to Hyderabad, minimum charge in a auto is 50 NP. Today, if I am going to sit in an auto, it is 20 rupees. How many times? You just tell me where is half rupee, where is 20 rupees? Right? If 50 NP will become 20 rupees, my 1 lakh of that day money will have present value of what? From that, if you look at what I am getting as 20 lakhs is a loss, is what my argument. Yes, law has given due consideration for this argument and brought the concept of inflation index, and this cost of acquisition must be inflated by giving a due consideration to the inflation index is the concept called as indexed cost of acquisition. But friends, at your level, understanding that there is a concept called as indexed cost of acquisition, and you have to reduce the indexed cost of acquisition from the net sale consideration while calculating the capital gains is not enough. Under what circumstances benefit of indexation will not be allowed is a point. Yes, when it is allowed, when it is not allowed, that is the main point of discussion. Benefit of indexation will be given only in case of a long-term capital assets. For short-term capital asset, when you make sale and then calculate the capital gains, benefit of indexation will not be given, and your cost of acquisition or improvement will not be allowed to take the benefit of the indexation. Right? Depreciable assets, I think all of you know, irrespective of the period of holding, depreciable assets are all short-term capital assets. Normally, if the period of holding is more than 36 months, it becomes a long-term capital asset. But irrespective of the period of holding, your depreciable asset is always to be treated as a short-term capital asset. So the benefit of indexation will not be given for the short-term capital asset, it will be given only to the long-term capital asset. There are few exceptions like bonds, debentures. Although these are long-term capital assets, still the benefit of indexation you are not giving. Similarly, if there is a non-resident and he is taking the route of first proviso to section 48, whereby sale consideration is converted into foreign currency, cost of acquisition is converted into foreign currency, cost of improvement is converted into foreign currency, expenditure is being converted into foreign currency, then capital gains is computed in foreign currency, and such a capital gains which is converted in foreign currency is reconverted into Indian currency. There we are not giving the benefit of indexation, because already you are converting everything into the foreign currency. Then the other issues is like slump sale. Slump sale में क्या होगा? That is net worth is considered as a cost of acquisition. There also you are not giving the benefit of indexation. Like that you should first understand where that benefit of indexation is not available is a point. Then friends, write down this particular point. Benefit of indexation. Benefit of indexation. Second proviso to section 48. Second proviso to section 48. Cost of acquisition oblique improvement. Cost of acquisition oblique improvement. is to be inflated with inflation index in case of long term capital assets. In case of long term capital assets. Now, next point, benefit of indexation. Benefit of indexation will not be allowed in the following circumstances. This is a question asked many times in the exam. Number 1, capital gains arising from transfer of bonds and debentures. Capital gains arising from transfer of bonds and debentures. Number 2, long term capital gains arising by sale of shares and debentures of Indian company by a non-resident, not only Indian, even a foreign company, non-resident. Then long-term capital gains arising in case of slump sale. Long-term capital gains arising in case of the slump sale. But friends, you please remember, units of Unit Trust of India and units of the mutual funds, there of course the benefit of indexation will be allowed. So don't get confused. When we say it is not available on bonds and debentures, that does not include the units of the Unit Trust of India or the mutual funds. On that you still can claim the benefit of indexation as long as they are the long term capital assets. Similarly, on equity shares and preference shares, very well you get the benefit of indexation. And there is one more concept called as indexed bonds issued by the government. There you can claim the benefit of indexation is a point. Of course friends, how to calculate, what is the formula for calculating the indexed cost of acquisition? See, you have to take the cost of acquisition and divide with the index of the year of acquisition and multiply with the index of the year of a transfer, right? So write down, indexed cost of acquisition is equal to cost of acquisition divided by inflation index of the year of acquisition, whole multiplied by inflation index of the year of transfer, whole multiplied by the inflation index of the year of transfer. Similarly, try to understand even for the cost of improvement divided by index of the year of improvement multiplied by the index of the year of transfer. But one point that you should remember is, let us suppose the asset is acquired prior to 1/4/1981. Then what the loss is, In respect of the assets which are acquired prior to 1481, the SC is given an opportunity either to take the actual cost or the fair market value as on 1481, whichever is higher, naturally the SC will take that. So, in respect of the properties which are acquired prior to 1481, the benefit of indexation will start from the base year of 81, 82, and what is the base year index? 100. Base year index is 100, and what is the current financial year 2011 and 12, which is relevant for you, for which the assessment year is 12 and 13, it is 785, right? So please make note of these two things, because in between years you need not by heart, in the examination they will give, because by hearting is virtually not possible unless and otherwise if a student is going to type everything in his calculator and keep it in memory and go and again make a recheck and make note of everything, then possibly yes, but we are not going to trouble the final students like that, and kindly don't resort to such unfair means, right? So write down cost of acquisition of the base year, that is 81 and 82, 100. Next, cost of inflation index of relevant previous year, that is 2011 and 12, 785. 785. Then friends, I will take one more proviso of section 48. What is that? Fifth proviso to the section 48. What it says? Securities transaction tax, if you are paying at the time when you are making a sale of a particular share, then that securities transaction tax will not be allowed to be reduced. Will not be allowed to be reduced. Why? Now the question is why? It is not allowed, already we have studied, sir. Why? Only because you are paying securities transaction tax, we are giving you, what is it? A concessional rate of tax. In case if the capital gains is arising, happens to be short term capital gain. If it is a long term capital gain, already there is an exemption which we are going to study in the due course. By sale of shares which are attracted to the securities transaction tax, then long term capital gains, if it is arising, it is getting exempted. If it is a short term capital gain, it is subjected to the concessional rate of a tax of 15% and all. So the point that you should remember is securities transaction tax is not allowed to be reduced as a related expenditure against the sale consideration. Now the point of interest here is try to understand, that is the case only when you are holding those shares as an investor. If you are holding those shares as a businessman who regularly deals in the shares, then this is not the principle. So when you are holding the shares and securities as a capital asset, as an investor, then securities transaction tax which you are paying at the time of making sale of those securities will not be allowed to be reduced as a point. If you are doing it as a business, then this is not the point of relevance there. Write down, no deduction shall be allowed, no deduction shall be allowed in computing the income chargeable under the head capital gains in respect of any sum, paid on account of securities transaction tax. paid on account of securities transaction tax. Then friends, we will take up the first proviso to section 48. Of course, probably I may end up this particular session with this particular discussion on the first proviso to section 48. What is the point here? That is, first proviso to section 48. First of all, why the provisos are there? Already there is a section 48. Why the provisos are given? That is what is stated in section 48. They wanted to create some exceptional situations. All those exceptional situations must be dealt by the provisos is a point. So we have covered which provisos? Second proviso to section 48 deals with the benefit of indexation, and fifth proviso to section 48 says that securities transaction tax will not be allowed to be reduced. Now what is this first proviso to section 48? See, India is a great country where we with open heart and enlarged arms, we invite the foreign people to come and invest in India. Friends, try to understand, the biggest asset for India is what? Its population. Really. And its mentality, people's mentality, prime, subprime crisis, all those things not affected the Indian context, Indian economy. Why? Recently I heard from one resource person this particular thing, which I am sharing with you. In India, if banks are giving the loans, what will happen, friends? Here what will happen? If I am going to a builder, the builder will first ask me, 50% you have to give in black, 50% I will take in white, right? So I will make use of my black money 50, for remaining 50 I go to the bank. Let us suppose property is 1 crore, 50 lakhs I make use of my black money. For remaining 50 lakhs I go to a bank and take a loan. Banker will give 75% of that, means 37.5 he is going to give, 12.5 I have to put my money, white money. Now when this loan is going to become a non-performing asset, naturally I have invested how much? 62.5 lakhs in that particular asset, just for defrauding the bank about the 37.5 lakhs, I am not going to make this particular asset a non-performing. I will find out a person who can purchase it and make sale of it, or I will make sale of the jewelry of my wife and try to repay the loan. Whereas this is not the case in foreign countries. That is, they are going to, there the banks are going to give 100% finance, and there is no concept called as black money. So that is the reason why after 4 months of usage, a person, if the banker asks why you are not paying, their people will purchase for 4 crores also the property. If after not paying 4 installment, if that bank takes, that fellow will say happily, okay, take it, because his money is not involved. There the, what is it, foreign banks got the problem, because just not just we should be restricted ourselves to the direct taxes as a future chartered accountants. Today when you go to the interview, if somebody asks what is prime, subprime crisis and all, at least you should talk. So that made me to just to share what I listened. Yes, all this discussion we are making because country today in Andhra Pradesh, if we see at least, I don't know about the rest of the country, every alternative house or every house has got one or the other who is there in the foreign country, and the children of the India are going to the foreign country, and we are inviting our Pranab Mukherjee, Chidambaram ji, all are going to the foreign countries and inviting the foreign investment into India. Now you should make some sort of tax benefits to those people, otherwise they will not invest in India. So we brought this concept called as a first proviso to section 48, because other way around they are living in developed countries and we are still developing country. So in that context, inflation here is very much, although you talk about benefit of indexation, still they don't love to listen that. So we brought this particular concept called as a first proviso to section 48, which says if a non-resident acquires a foreign exchange asset. What is foreign exchange asset? An asset which is purchased with foreign currency, that is shares and debentures in Indian company. If they are purchasing with that foreign currency, then if subsequently they make sale of such shares, then there is a special methodology which is prescribed. What is that special methodology? First, the sale consideration which they receive in Indian currency must be converted into foreign currency. Using which exchange rate? Telegraphic transfer buying rate plus selling rate, average of it on the date of sale. Similarly, the cost of acquisition must be converted with the average of TT buying and TT selling. Even the expenses must also be converted into what is it, foreign currency, by applying which rate? Average of TT buying and TT selling. Then you calculate the capital gains in foreign currency and convert them into Indian currency. Using which rate? Not average, buying rate. So that is a specific procedure which is prescribed by the first proviso to section 48. So will you just make note of this, because at the final level at least I feel probably this kind of sections could well appear in the paper also. First proviso to section 48. Computation of capital gains. Computation of capital gains in case of non-residents. In case of non-residents. Conditions. Number 1, non-resident includes foreign company. Then number 2, shares and debentures in Indian company are acquired by the non-resident in foreign currency. Note, debentures include bonds. However, bonds of central government, state government and RBI, units of UTI, units of mutual fund, are not subjected to first proviso to section 48. That is to say what, friends? What the procedure we discussed is not applicable there. Then, irrespective of the fact whether those shares and debentures are listed or unlisted, first proviso to section 48 will apply. And one more important thing is, this is not an optional, it's a mandatory. Write down. First proviso to section 48 is a mandatory, is mandatory. Second proviso to section 48 will not apply. Second proviso to section 48 will not apply. What is second proviso, friends? Giving the benefit of indexation is the second proviso. So already I made you to write that particular point, that benefit of indexation will not be applicable in case of those who are covered by the first proviso to section 48, that is non-residents making sale of shares and debentures acquired in foreign currency. Then second, the first proviso to section 48 is applicable. First proviso to section 48 is applicable both for long term capital gains as well as short term capital gains. Now, the procedure of or the method of calculation which I explained is being dealt by the rule 115A. Write down rule 115A. Method of computation. Method of computation. Sale consideration, point number 1. Sale consideration is to be converted into sale consideration received in Indian currency. Sale consideration received in Indian currency is to be converted into foreign currency using average of TT buying and TT selling rates. Average of TT buying and TT selling rates as on the date of transfer, as on the date of transfer. Next, less expenditure in connection with the sale incurred in Indian currency being converted into foreign currency, using average of TT buying and TT selling on the date of transfer. Less cost of acquisition in Indian currency being converted into foreign currency, using average of TT buying and TT selling as on the date of acquisition. So the balance represents what? Capital gains in foreign currency. Balance is what? Capital gains in foreign currency. Now, capital gains in foreign currency, capital gain in foreign currency is to be converted into Indian currency by applying TT buying rate as on the date of a transfer, as on the date of transfer. Of course, friends, here one noteworthy point is what? Let us suppose that non-resident is holding those shares for more than 12 months. Those shares are of Indian company. And when he makes sale of it, it is subjected to the securities transaction tax. Now automatically what will happen? 10 clause 38 will come into play. If any SSE makes sale of the shares which are subjected to the securities transaction tax and the resultant capital gains happens to be, what is it, the long term capital gain, then such a long term capital gain gets exempted under section 10 clause 38. All this is relevant when, only when such shares and debentures are of short term capital assets. When the non-resident makes sale of that as a short term capital asset, what will happen? That is, then you have to calculate using this particular procedure, right? And then you have to pay the tax at what rate? At the rate of 15%, because short term capital gains under section 111A, which are subjected to the securities transaction tax, will be subjected to the tax at what rate? At the rate of 15%. These are the finer points that should go into your mind. So with that, so far what we have discussed in this session is, I started the capital gains topic with the charging section of section 45. We discussed what is capital asset, what is to be regarded as a transfer, then we discussed certain issues related to this, and then we discussed the method of computation of the, what is it, capital gains by discussing section 48. But please do remember, this section 48 deals with only those capital assets excluding the depreciable assets, because depreciable assets is being dealt by the another section. And then we have got in section 48 the first proviso dealing with, that is exception is non-residents purchasing shares and debentures of Indian company using foreign exchange. Then for them there is a specific procedure of computing the capital gains, and benefit of indexation will not be given. And the second proviso to section 48 deals with benefit of indexation, and benefit of indexation is available only for the long term capital assets, and under what circumstances, under what situations, although the asset is a long term capital asset, benefit of indexation will not be given, already we have discussed. For the bonds and debentures, benefit of indexation will not be given. Similarly, in case of the one who is covered by the first proviso to section 48, slump sale, these are the situations where you don't get the benefit of indexation. We also discussed the point of fifth proviso to section 48, which deals with the situation of securities transaction tax, and it is not going to be allowed as a deduction against the calculation of the capital gains as a point, because once it is a securities transaction tax is paid, if it is a long term capital asset and the resultant gain is a long term capital gain, it gets exempted under 10 clause 38, whereas if it is a short term capital gain, since you are paying securities transaction tax, government is kind enough to say that it is subjected to a concessional rate of tax of 15% as a point.